Right now, as you are watching this video, the global financial system is experiencing a shock that most people have no idea is happening. Not a correction, not a dip, a structural collapse of the debt supercycle that has quietly powered the world economy for the last 4 decades. And the trigger was not a bank failure. It was not a Federal Reserve mistake. It was a war that erupted on February 28, 2026, when the United States and Israel launched coordinated strikes on Iran, and Iran responded in a way that no financial model, no geopolitical playbook, and no Wall Street algorithm had fully prepared for. By the end of this video, you are going to understand exactly what the debt supercycle is, why this war has cracked its foundation, what the domino effect looks like in real time, and most importantly, what you need to do right now to protect yourself from what is coming. Stay with me until the very end, because the final chapter of this story is the most important piece of financial intelligence you will hear all year. Let us start at the beginning, not February 28th, not the airstrikes. Let us go back even further, because to understand why this war is so economically catastrophic, you need to understand the machine that was already running on borrowed time before the first missile was fired. For the past 40 years, the global economy has been operating on a single, elegant assumption. That assumption is this: debt can always be rolled over, interest rates can always be managed, and the energy that powers civilization will always flow freely from the Persian Gulf through the Strait of Hormuz to the factories and refineries and cities of the world. This assumption was the invisible foundation of what economists call the debt supercycle. Governments borrowed, corporations borrowed, consumers borrowed, central banks printed money to keep the whole system liquid. And because energy was cheap and abundant, because oil at $60 or $70 a barrel made everything from manufacturing to food production to transportation affordable, the debt never became unbearable. The math always worked, barely, but it worked. Then on February 28, 2026, that assumption was shattered in a single night. The strikes began before dawn. U.S. naval destroyers in the Arabian Sea launched Tomahawk cruise missiles. F-35 and F-A-18 aircraft took off from carrier groups and regional air bases. Israel deployed its most advanced Air Force assets. The stated objectives were Iran's nuclear infrastructure, its ballistic missile production facilities, and the leadership that commanded them. In the first hours of the attack, Supreme Leader Ali Khamenei was killed. Senior military commanders were eliminated. Command and control infrastructure across Iran was struck. The U.S. Central Command would later confirm that in the first 2 weeks alone, American forces hit more than 7,000 targets inside Iran. Iran's response was not what Washington expected. It was not symbolic. It was not a few missiles fired to save face. Iran activated a strategy it had been quietly preparing for years, a strategy that did not aim to defeat the United States militarily, because Iran knows it cannot do that. Instead, Iran aimed to make the economic cost of this war so catastrophic, so globally painful, that the world would be forced to demand it stop. On March 2nd, 2026, a senior official in Iran's Islamic Revolutionary Guard Corps made an announcement that sent shockwaves through every trading floor on the planet. The Strait of Hormuz was closed, not theoretically closed, not symbolically threatened, operationally closed. Iranian forces began attacking vessels attempting to transit the strait. Insurance companies immediately pulled war risk coverage for ships in the region. Without insurance, no commercial operator could legally or financially justify sending a tanker through. Within 48 hours of that announcement, tanker traffic through the world's most critical energy choke point dropped to near zero. And what flows through that strait is not just oil. It is the lifeblood of the entire global economy. Think about what that actually means. Roughly 20 million barrels of crude oil pass through the Strait of Hormuz every single day. That is approximately 20% of all the oil traded on the global market. The strait is also the transit route for nearly 20% of the world's liquefied natural gas. And beyond energy, it carries fertilizers, industrial chemicals, helium for semiconductor manufacturing, sulfur, and dozens of other commodities that most people never think about, but that underpin the entire supply chain of modern civilization. When that strait closes, it is not just an energy crisis. It is a cascade failure across multiple industrial systems simultaneously. Now, let us talk about what happened to oil prices, because this is where the debt supercycle story really begins to accelerate. Before the war, Brent crude was trading at approximately $65 per barrel. That was the world financial models were built on. That was the energy cost that governments, airlines, shipping companies, food producers, and central banks had factored into their economic projections for 2026. Within days of the Hormuz closure, Brent crude surged past $80, then $90. On March 8th, it crossed $100 per barrel for the first time in 4 years. It kept climbing. By mid-March, Brent was trading above $110, and the Dubai crude benchmark, the pricing reference for Asian buyers, hit an all-time record above $150 per barrel. Let that sink in. A $150 oil price is not just expensive, it is a civilization-level economic stress event. Every single product that is manufactured, transported, packaged, refrigerated, or grown using petroleum-based inputs becomes dramatically more expensive. That means food, that means medicine, that means electronics, that means everything. Now, here is where it connects directly to the debt supercycle. The global debt supercycle works on one critical assumption: that inflation stays manageable enough for central banks to keep interest rates low enough to make debt affordable. When oil goes from $65 to $150 in 3 weeks, you do not just get an energy shock. You get a structural inflation shock that central banks cannot control with the tools they have. And when central banks cannot control inflation with low rates, they are forced to raise rates. And when rates go up on a world that is carrying more debt than at any point in human history, the mathematics of debt repayment becomes impossible for a growing number of borrowers, from emerging market governments to heavily leveraged corporations to ordinary homeowners. This is the mechanism. This is how a war in the Persian Gulf becomes a global debt crisis. And it is already happening in real time. The Council on Foreign Relations published an analysis in March 2026, confirming what market participants were already seeing. Higher energy prices were raising expectations that inflation pressures would limit central banks' ability to lower interest rates. Those expectations, combined with anticipated increases in government defense spending and massive new debt issuance to fund military operations, pushed longer-term government bond yields higher. The MSCI All-Country World Index, which tracks global equity markets, reflected more than 5% losses since the war began in late February. That is, trillions of dollars in wealth evaporated in weeks. But the equity market losses are actually the least of your worries. Because underneath the stock price movements, something far more structural is cracking. Let us go to the Gulf countries now, because what Iran did to Saudi Arabia, the UAE, Kuwait, Qatar, and Bahrain is a story that has been dramatically underreported in Western media. Iran did not just target Israel and U.S. military bases. Iran executed a comprehensive campaign against the entire Gulf Cooperation Council. The logic was precise and brutal. Most Gulf states host American military infrastructure. The UAE hosts American forces. Bahrain is the headquarters of the U.S. Navy's Fifth Fleet. Qatar hosts the largest American air base in the entire region. Kuwait has hosted American forces for decades. Saudi Arabia, despite its complex relationship with Iran, was also in the targeting matrix, partly because Saudi Crown Prince Mohammed bin Salman had reportedly lobbied Trump repeatedly to authorize the strikes on Iran in the first place. So Iran declared all of them legitimate targets. And then it struck them, not once, repeatedly, over days and weeks. Bahrain's capital, Manama, was hit. The U.S. Navy's Fifth Fleet headquarters was struck multiple times. Qatar's LNG facilities were attacked by Iranian drones. Kuwait's oil fields were targeted. Saudi Arabia's energy infrastructure was threatened, with Iran specifically naming Aramco's Samref refinery and the Jubail petrochemical complex as future targets. Now consider what this means economically. The Gulf Cooperation Council countries are not just oil producers. They are the anchor of global petrochemical supply chains. They are major sovereign wealth fund holders. They are critical nodes in the global financial system. When Iran systematically targets their infrastructure, it is not just disrupting energy supply. It is signaling to global capital markets that the assumed stability of the Persian Gulf, the stability that has been priced into everything from sovereign debt ratings to corporate bond spreads, is no longer guaranteed. And then Iran struck South Pars. This single event on March 18th may prove to be the most consequential economic event of the entire conflict. South Pars is the world's largest natural gas field, shared between Iran and Qatar. Iran's side supplies massive amounts of gas to domestic and regional markets. Qatar's side, known as the North Field, is the source of roughly 1/5 of the world's entire LNG supply. When U.S. and Israeli aircraft struck South Pars and the surrounding infrastructure, oil prices immediately spiked more than 5% to nearly $110 a barrel. But more critically, it raised the terrifying possibility that Qatar's LNG exports, which power factories and heat homes from Germany to Japan, could be disrupted. European natural gas prices had already nearly doubled since the conflict began. Another disruption of this scale would push them even higher. Qatar's foreign ministry condemned the strikes as dangerous and irresponsible, but the market's reaction was pure panic, because this is where the Hormuz crisis stops being an energy problem and becomes a full-spectrum economic emergency. Let us talk about Asia, because the economic pain in Asia right now is not getting the attention it deserves in Western financial media. And understanding it is absolutely critical to understanding what comes next for the global economy. More than 80% of all oil and LNG that passes through the Strait of Hormuz goes to Asia. China imports roughly 40% of its oil from the Middle East. Japan relies on the Middle East for approximately 90% of its crude oil imports and routes more than 95% of that supply through Hormuz. South Korea gets about 70% of its crude from the Middle East. India's entire economic growth story depends on affordable energy from the Gulf. Vietnam had oil reserves estimated to last less than 20 days when the strait closed. Pakistan and Indonesia had approximately 20 days. These are not wealthy countries with deep financial buffers. These are economies where a doubling of energy costs directly translates into political instability, food insecurity, and potential debt default. South Korea has already moved to activate a $100 trillion one market stabilization program, roughly $68 billion just to manage the volatility triggered by this war. Japan is facing its most serious energy security crisis since the 1973 oil shock. India is watching its current account deficit explode in real time as its oil import bill surges. And here is the link that almost nobody is talking about yet. These Asian economies are major holders of U.S. Treasury bonds and other dollar-denominated assets. When they face domestic financial crises, when their currencies come under pressure, when their governments need to fund emergency energy subsidies, one of the tools they use is selling their reserve assets. When Japan, South Korea, India, and others begin selling U.S. Treasuries to raise cash and defend their currencies, American bond yields go up. And when American bond yields go up, the cost of the U.S. government's own debt servicing rises. And the U.S. government is already running deficits so large that even before this war, analysts were warning about long-term debt sustainability. This is the debt supercycle feedback loop. It starts with a physical disruption in a sea lane. It translates into an energy price shock. The energy price shock creates inflation. Inflation forces higher interest rates. Higher interest rates make existing debts more expensive. Countries under pressure sell assets to survive. Those asset sales push yields higher in America and Europe. Higher yields increase debt costs for governments already running deficits, and the whole system begins to compress. This is not theoretical. This is happening right now. Let us look at what the International Energy Agency is doing, because their response actually tells you everything about how serious the situation has become. The IEA announced the largest emergency oil reserve release in its history, 400 million barrels. The United States committed to releasing 172 million barrels from the Strategic Petroleum Reserve over 120 days. These are numbers that sound enormous until you do the math. The U.S. Energy Information Administration estimates global daily oil consumption at roughly 105 million barrels per day in 2026. Normal daily flow through the Strait of Hormuz is about 20 million barrels. 400 million barrels from emergency reserves equals approximately 4 days of global consumption at the pre-crisis rate. Even compared to normal Hormuz traffic, it is just 20 days of supply. And the IEA's own executive director acknowledged publicly that while the reserve release can provide a temporary buffer, it is not a lasting solution. The single most important factor for stable oil prices is the physical restoration of free navigation through the Strait of Hormuz. And that is a geopolitical problem, not an economic tool. Washington has tried to get allies to help force the strait open militarily. It has not worked. Trump publicly scolded NATO allies and partners, including Japan, Australia, and South Korea, for failing to provide stronger military support. The European Union, after a meeting of foreign ministers, decided against expanding its naval operations in the Middle East. EU Foreign Policy Chief Kaja Kallas said plainly that Europe has no interest in an open-ended war. The UK said it would not be drawn into the wider conflict. So the US finds itself in an extraordinarily difficult position. It has started a war that has produced an economic crisis, not just for its adversary, but for its allies. And those allies, facing their own economic pain, are refusing to help escalate further to solve the problem America created. This is the geopolitical bankruptcy that sits alongside the financial bankruptcy. And it matters for markets because it means there is no clear, fast political path to ending the Hormuz disruption. Now, let us go deeper into the debt supercycle itself, because this concept is the central thesis of everything you need to understand about your own financial future. The debt supercycle is a macroeconomic concept that describes multi-decade periods in which total debt in the global economy expands far faster than underlying economic growth. The last major debt supercycle began roughly in the early 1980s, when financial deregulation, globalization, and the beginning of a long decline in interest rates created conditions in which governments, corporations, and consumers could borrow cheaply and continuously. That cycle was extended and extended and extended. Every time it threatened to contract, central banks cut rates. Every time a crisis emerged, they printed money. After the 2008 financial crisis, they cut rates to zero. After COVID, they printed trillions. Global debt went from roughly $100 trillion before the pandemic to nearly $350 trillion by 2026. The entire architecture of this system required three things to keep functioning. First, it required low and stable inflation so central banks could keep rates low. Second, it required political stability in the major energy-producing regions of the world so that oil and gas remained available and affordable. Third, it required confidence in the dollar system and in the U.S. Treasury market as the ultimate safe haven for global capital. The Iran war is attacking all three pillars simultaneously. Inflation is surging because of oil and food prices. The major energy-producing region is at war, and confidence in U.S. leadership of the global financial system is being tested as America's allies face economic pain from a war they did not choose while refusing to help America solve it. When all three pillars are stressed simultaneously, the debt supercycle does not just slow down, it starts to reverse. And a reversal of a 40-year debt supercycle is not a recession. It is a generational restructuring of the global financial system. Here is what that restructuring looks like in practical terms. Governments that have been running large deficits funded by cheap debt will face rising borrowing costs. Some will be forced to cut spending dramatically, triggering political crises. Others will try to inflate their way out, printing money and triggering currency crises. Corporations that loaded up on cheap debt for buybacks and acquisitions will face refinancing crises as their debt matures at much higher rates. Pension funds and insurance companies, which depend on bond markets for stable returns, will face portfolio stresses. Real estate markets, which have been inflated by low rates for decades, will face downward pressure as financing becomes more expensive. And ordinary consumers who have relied on cheap credit for housing, cars, and daily expenses will find the cost of debt suddenly much more painful. None of this happens overnight, but the direction is now set. The war in Iran has not caused all of these problems, but it has acted as the accelerant that could turn a slow burn into a fast fire. Let us now look at something that almost no mainstream financial media outlet is covering adequately, the China dimension. And this is where the story becomes truly extraordinary. Iran has reportedly been in discussions about allowing cargoes traded in Chinese yuan to transit through Hormuz, even as it blocks ships from the U.S., Israel, and their Western allies. Iranian vessels and Chinese-flagged ships have been allowed to continue operating in the strait while American and European tankers are blocked. China, which has large strategic oil reserves and established partnerships with both Iran and Russia, is actually positioned to benefit from this crisis in the short term. Chinese companies are offering to intermediate energy supplies. Russia, suddenly freed from some Trump-era sanctions pressure that was eased to try to increase global oil supply, is earning an estimated $150 million per day in additional revenue from higher oil prices and redirected Asian demand. What this means geopolitically is profound. The Iran war is accelerating the bifurcation of the global energy market. On one side, a U.S. dollar-denominated system increasingly strained by physical disruption, allied discontent, and financial stress. On the other side, a one-ruble-rial axis that is quietly expanding its operational capacity in the shadows of the conflict. Every week that the Strait of Hormuz remains functionally closed to Western shipping, China's alternative energy infrastructure, its overland pipelines, its Iranian partnerships, its Russian supply relationships becomes more valuable and more entrenched. This is not just an energy story. This is a dollar story. The petrodollar system, the arrangement under which global oil trade is priced and settled in U.S. dollars, giving America its extraordinary financial privilege, is being challenged in real time by this conflict, not replaced, not immediately dismantled, but challenged and eroded in ways that will have long-term consequences for American borrowing costs and the dollar's reserve status. And here is where the debt supercycle and the geopolitical crisis converge in the most dangerous way. America's ability to run large deficits without triggering a bond market crisis depends critically on the dollar's reserve currency status. Foreign countries hold dollars and dollar-denominated assets because they need dollars to buy oil and because they trust the U.S. financial system as a safe haven. If that trust erodes, if other energy trading mechanisms gain credibility, America's cost of debt financing rises. And at $350 trillion of global debt, with America itself carrying the largest nominal government debt load in history, even a modest, sustained rise in borrowing costs begins a compression that becomes self-reinforcing. This is the debt supercycle collapse, not a crash in a single day, a structural compression over months and years where the mathematics of debt that once worked barely but consistently begins to fail, where refinancing becomes difficult, where asset prices fall as the tide of cheap money retreats, where the economic growth that was borrowed from the future comes due. So what do you do? What are the actual, practical, actionable steps that intelligent people who are paying attention should be taking right now. The first thing is to understand your own debt exposure. If you are carrying variable rate debt, you need to take that seriously. The direction of interest rates in an inflation-driven, geopolitically stressed environment is upward, not downward. Refinancing at a fixed rate, reducing outstanding balances, and building cash flow flexibility are not optional considerations right now. They are urgent priorities. The second thing is to think carefully about your energy cost exposure. If your business or your household is highly sensitive to energy prices, whether through transportation costs, heating costs, manufacturing inputs, or supply chain dependencies, you need to be planning for sustained higher energy costs. The IEA's reserve release is a temporary buffer. The physical problem in the Strait of Hormuz has no quick fix. Plan for energy at elevated prices for an extended period. The third thing is to consider your portfolio's geographic and sector exposure. Commodity exporters, energy producers, and companies with strong balance sheets and pricing power perform relatively better in inflationary, high-rate environments. Highly leveraged companies, long-duration bonds, and rate-sensitive sectors face the most stress. This is not investment advice, but the directional understanding matters for how you think about risk. The fourth thing is to pay close attention to the dollar and to what is happening in Asian currency markets. If Asian economies begin selling Treasury assets at scale, you will see early warning signs in the Treasury market in yen and won and rupee exchange rates and in U.S. bond yields. These are the metrics that will give you the most advanced warning of the next phase of the debt supercycle compression. And the fifth thing, perhaps the most important, is to resist the temptation to believe that this situation will resolve itself quickly because it has always resolved itself before. Every previous Middle East crisis, 1973, 1979, 1990, 2003, did eventually stabilize. Oil prices did eventually come down. The global economy did eventually recover. But each of those crises occurred in a world with lower total debt, more financial policy space, and a more cohesive Western alliance. Today's crisis is occurring in a world with record debt, nearly exhausted monetary policy tools, a fractured Western alliance, and a China that is actively benefiting from and strategically positioning itself around the disruption. The risk this time is not that the crisis lasts forever. It is that the damage done during this period of elevated stress tips enough leverage borrowers and institutions into failure that the debt supercycle contraction becomes self-sustaining even after the physical energy disruption is eventually resolved. Now let us take a step back and look at the full picture, because here is the most important thing to understand as we close out this analysis. What is happening right now is not random. The Iran war is not an isolated event that came out of nowhere. It is the stress test that the global financial system was always going to face at some point. For 40 years, the world borrowed more than it earned, spent more than it produced, and consumed more energy than it was willing to secure through diversification. The Strait of Hormuz was always the single point of failure that could crack the entire system. And now that crack is visible The question is not whether the global economy will feel pain from this. It will, and it already is. The question is whether policymakers, investors, businesses, and individuals adapt quickly enough and wisely enough to navigate the transition that is now underway. Some will. Those who understand what is happening, who position their finances defensively, who reduce debt and increase resilience, who pay attention to the signals rather than the noise, those people will come through this period in a position of relative strength. Those who assume that because the TV anchors sound calm and the stock market has only fallen 5% so far, that nothing fundamental has changed, those people are going to be caught off guard. The debt supercycle that powered 40 years of global growth is cracking. The Iran war is the trigger, not the cause. The cause has been building for decades. And the most important thing you can do right now is to understand the mechanism, take it seriously, and take action while there is still time to position yourself wisely, because the Strait of Hormuz is still functionally closed. Iranian drones are still targeting Gulf energy infrastructure. Oil is still above $100 a barrel. Bond yields are still rising. And the world's most indebted governments are still trying to figure out how to pay for a war while managing a financial system that was already stretched to its limits before the first missile was fired. This is the moment that will be studied in financial history courses for the next generation. The question is whether you are a case study in who saw it coming or who did not.